traders, in this video I'll show you how to do top-down analysis, the advanced way to do top-down analysis. And this advanced way doesn't have to be complex or difficult, it just has to be simple. Alright, so number one here, you can see identify overall market structure on the higher time frame. And number two, move to the 4-hour time frame to mark points of interest. You may ask, what are points of interest? Point of interest is simply your institutional reference point, like your fair value gap, your order block, your mitigation block, your breaker block, and the rest. Now, number three, we move to the 1 hour or 15 minutes time frame for entry. So what we are actually doing, when we mark our point of interest in the 4 hour, we wait for price to retrace on the 1 hour or 15 minutes for entry. Price has to retrace back to our point of interest where we are going to look for entry. Alright, let's dive into the chart. Alright, so on the chart, we want to analyze GBP USD. First of all, before analyzing GBP USD, Euro USD, or AUD USD, any USD foreign pairs, you need to go to the XY. The XY is a dollar index to know the direction of the XY because they are negatively correlated. So if the XY is buying, we want to be selling on GBP USD, Euro USD, and AUD USD. And if the XY is selling, we want to be buying on GBP AUD USD. So actually, the XY is the driver. The XY is like the driving force or like the king of foreign pairs. So alright, let's go to the XY. So the XY is simply our US dollar index. US dollar index. This is what determines the movement of the price. On the weekly time frame, we can see what the market is doing. From what is the, first of all, we are identifying the overall market structure. So this is basically an uptrend. This is a massive uptrend on the weekly time frame, right? Now we'll move down to, we can see how price has been creating. This is a low, a higher high, it's higher low, higher high. This low took out the previous low, then boom, it created a change of character again here on the weekly. So we can actually see that this market is going up. Create a change of character here. So we can see that this market is going up. Alright, so we move to the daily time frame. So we can see that this market is on a massive uptrend. So creating a low, a high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. So we are expecting another higher high. So we are expecting price to take out this draw on liquidity here. We're expecting price to take out the draw on liquidity here. Yeah. Alright. So now we can as well mark our institutional reference point on the daily time frame, and we can also do that on the 4-hour time frame, because on the daily time frame I can see how price has been respecting this fair value gap here. Price traded into it, this fair value gap, and boom, and move up, and price traded into this. This is another block that price traded to. This is a huge order block. We can actually use this big one, right? We can use this small one here. This one, another small one here. We can use it. Let's use the big one. We can see another fair value gap here. So this is a recent fair value gap that price traded to on the daily time frame, right? So first of all, price created a break of structure here. Created a break of structure. We are seeing that the market is going up, is bullish. So then retrace into the fair value gap, and we're expecting to move up. So now we can go to the 4-hour time frame as well. We can also still mark our points of interest where we want price to trade into. So already we did that on the daily time frame. Now we can see this fair value gap here that price traded into, right? Price traded into this point. So this is actually our point of interest. We're expecting price to start going up from here. But in looking at this chart, we can't really find entry. We can't really find entry here. So what we do, we scale down to the 1-hour time frame. On the 1-hour time frame, so here price traded into the fair value gap, and we can see a change of character here. This is a change of character that shows that this market is going up. So let's mark that, a change of character, very small change of character here. Then we saw price retrace, and also when the price created that change of character, there is a fair value gap here on the 1 hour time frame. After creating this change of character, we know they were expecting price to retrace back, then push up. So price didn't come down to this fair value gap immediately. Price didn't come back to it immediately. So this market went up like this, created a change of character, came back, it didn't come back to the fair value gap. It didn't come back to the fair value gap. And this created what we call inducement. This created inducement because when you take your Fibonacci, to and mark, when you mark from this low to this high, you see it actually came down to the 50%, right? It just touched the 50% and boom, started going up. But it didn't come to this fair value gap. So if you sold from here, if you bought from here, well, if you bought from here, let's say you bought from this point, you'll be targeting this point, right? Because we're expecting price to come back to this fair value gap. So if you bought from here, let's say you just bought somewhere here, you're expecting price to go up from here, you set your TP at this high, at the previous high there, because that was just what the market did, and boom, it came back to induce this place, because this was a draw on liquidity. So let me take this out. So it came back to induce. This is inducement. The price came back to induce. Right? You can just put it, okay, IND, inducement. Then the price traded fully into this fair value gap. Price traded fully into this fair value gap. Now can we enter here now? We can't really enter here now, so we'll move down to the 15-minute time frame. We are also looking for more confirmation, right? More confirmation. So we can see on the 15-minute time frame that here now price created a change of character here. This is also another change of character here. We can use this one. If this one is the most obvious, we can either use this one or use this one. Let's use this one. So price created a change of character. Price created a change of character. We're expecting price to come back to this fair value gap. So there's a fair value gap here that price created. The market created a fair value gap here, and you can see how nicely price came to mitigate this fair value gap. So we can actually buy here. We could just set we could take this trade from here. Now we can buy this trade. If we can take this trade from here now and set our stop loss here. Let's take this trade. So we'll take this trade. Our stop loss will just be below this point here. Stop loss will just be here, and we can target on 15 minutes. We can target this point. If we want to swing this, we want to take this trade far, want to swing trade, we can target this, the high of this movement. That's the swing high. We can target this swing high, right? So if you want to hold this trade, this is like a swing trade. If you want to day trade, you can just target this point. You can target this point. This could be your TP1, TP2, TP3, and TP4, right? All right. So now we've known the direction of the dollar index, that is bullish, which indicates bearish move on GBP, Euro, and AUD USD. So now let's move to GBP USD. So going from the weekly time frame, we already know that the dollar index is bullish, so the GBP is going to be bearish. So we can see how bearish this move is. We can see how bearish the weekly time frame is, but we can't just enter here. We have to go down to the, let's say we go down to the daily. So we already know what's happening, so we can as well move down to the daily, right? Okay, see how price is, what price is doing. Then let's move to the 4 hour. 4 hour will give us more data. So on the 4 hour time frame, we can see how price traded into this order block. Price traded into this order block here, this bullish order block, creating a small fair value gap here, creating a tiny order fair value gap here. So we know that we are going to sell this market, right? So now we can just move to 1 hour to actually see what the market is doing. So on the 1 hour, we saw a change of character. Okay, we saw a change of character here. Did it really change? Okay, this is a week. We can use this as a change of character, and we're expecting price to move up. So this is, we identify this as my change of character. Identify this as my change of character. Okay, so now we're expecting a retracement. There's a fair value gap here, there's even another one here, so we're expecting a retracement. So you may ask which fair value gap is the right one to use. We'll use any one that is on the discounts, sorry, is on the premium zone. So when we take our Fibonacci 2, we draw, take our Fibonacci 2. So already this market has gone into this, it has passed the 50%, which is our equilibrium. So we can as well wait for price to get to this point, or since it has entered this 50%, it has passed the 50% into the premium zone, we can just sell here. We can sell here and put our stop loss here. But already we need more confirmation. We just need to go to the lower time frame. We need to go to like 15 minutes to get more confirmation. So on the 15-minute time frame, we are still seeing this fair value gap here. So if we want to take this trade to be on the safer side, we can take this trade like this. We can sell here and our stop loss will be here. But that will be too far, right? That will be too far. Our stop loss will be here. Then we are targeting this point. We'll be targeting the next low. Okay, so this will be our target. This will be our target. So that stop loss is too far, is too much. We can, if we go to the 5-minute time frame, okay, so on the 5-minute time frame we can also see a change of character here, a retracement to this small. On the 5-minute time frame we can see a change of character here, right? Okay, and we can also see the fair value gap here that price traded into. We can see the fair value gap here that price traded into, right? So price traded into it already. So now we can take this trade and put our stop loss here, just above. We can put it here above the fair value gap, or we put it here for safe entry. We just put it here and we allow this trade to run all the way down. So this is, we just allow this trade to run all the way down. This same thing goes for other pair. US, this is Euro USD. You can see we're expecting the bullish, a bearish move. We're expecting it to move down to this point. We can also check AUD. We're expecting price to come down. These are all liquidity that price is going to target. So check AUD. So you can see I'm currently on this trade, so we can see how price is going to go down nicely. Alright guys, so this is basically how to do top-down analysis. Alright guys, thank you so much for watching. If you found this video helpful, kindly like and subscribe. See you in the next video. Bye.